Good morning, friends. Good morning, good afternoon, good night, my friends, depending where you are in the world. Can you guys hear me? Can you guys hear me in the YouTube chat? Is it a new mic? Everything should be the exact same. No, nothing has changed. Yes, Dad. Thank you, Mr. Jin. I'm going to be giving you guys a full economic lesson today, okay? Is the audio and visual all good? Some people saying they can't hear me. Hello, can you hear me? Okay, everybody. So welcome to the Capital Hungry New York trading session and NFP stream. The main focus of today is going to be focusing on US jobs data and the potential impact of the US jobs data. All right. So don't worry. It's only 7:30 a.m. Eastern right now. Okay. I know the hyenas, they're itching to blow their account at NFP release. They just deposited $100 last week. They just put in another $200 today. They are itching to blow their account. I know your heart's racing. You feel very excited. You think you're going to make money today. But please relax, okay? Let's take this step by step. We're going to take everything step by step. I'm going to be giving you guys a full breakdown of my opinion on non-farm payroll as well as the overall state of US economic data, okay? And how this also ties in with the signals we're getting from the central bank, okay? And I'm going to be using gold and the US dollar as an example. All right? So, obviously we have 1 hour, 60 minutes until non-farm payroll release. Do you guys mind, do you guys and gals and other genders mind that if I spend the 60 minutes breaking down the fundamentals and technicals? I know people find it very boring. I know people say it's too much information, but it's what interests me. It's what I like to do, and it really gives me a good understanding of the markets as well. So, do y'all mind or no? Do you mind for the next 60 minutes that I just give you guys a full lesson from my view? Okay, perfect. Thank you. So if any trolls or if any hyenas come, right, and they say, oh, this is too much information, fundamentals are useless, this stuff sucks, you guys make sure to shit on them, all right? So I don't get distracted and I can keep giving you guys information, all right? Okay, first off, don't worry about the stream reminders. Understand, okay, that even if the fundamental economic data shows us one-sided volatility, and what I mean by that is, let's just say the non-farm payroll data is extremely good, right? We have the NFP is very strong, the wages data is very strong, and the unemployment rate is very good and shows us a decrease. Even if you can have all the data being extremely strong, that doesn't stop the potential volatility and liquidity grabs that the institutions can do to set up better price points for themselves. You guys have seen it many times before where non-farm payroll release can do almost like a 50 to 100 pip liquidity grab and look like it's about to go in one direction, collect orders, and completely reverse the move following the economic data. So understand that for you as a manual retail trader, most likely that volatility at the actual release of data, most likely that volatility will probably be dangerous to you and destroy your account, because most likely you're going to get spread spikes, you're going to get entry slippage, you're going to get stop loss slippage, okay? So what I advise, like I know for example, some people, like I know Raja, they like to do some buy stop, sell stops. And if you are willing to take the risk on that, that is perfectly fine. There's 1,000 ways to trade data releases. There's 1,000 ways to trade the potential news. I have my style of trading it, which I find a lot less risky and more following the actual data, technicals, and fundamentals in combination, right? So what I like to do is first look at the data release and assess and digest the data and understand if it's going to be either good or bad or mixed, right? If the data is very good, for example, then I will deduct the impact on the markets, because you can get very lost in translation here where sometimes, like let's just say for example, NFP is extremely good. The expectation is if the US economic data is good on something like gold, you should just have a drop, right? Because you're having stronger economic data, which would decrease the demand as a precious metal safe haven and essentially have sell orders flood gold. But that isn't always the case. You can have the NFP data being extremely good and get like a 50 to 100 pip liquidity grab, collect more sell orders, then potentially continue your way back down, right? So I always like to be a bit more patient, and I find that the issue is a lot of retail traders, they want to catch the entire move of NFP. You do not need to catch the entire move of NFP and be a hero to make some profit and to also consistently grow your account. Even if you catch 20%, 30%, half of the move of NFP, if the volume and volatility is there and you have the one-sided economic data, either very good data or very bad, once you wait for your confirms and catch that piece, you have way more confidence, you have way less risk, your heart's not racing, and you're not trying to chase something without having any information. Because essentially at the end of the day, if you're taking a trade and executing a trade before the actual non-farm payroll release, you're playing a guessing game. I don't care who you are. You do not have access to the institutional order flow to understand if there's going to be a liquidity grab, if there's going to be a whipsaw, if spreads are going to spike, if you're just going to instantly push up or instantly push down, how much you are going to push down or push up by. These are all factors you have no clue about, right? You could potentially be having a guess for what you think the data is going to be, but everything else I said, you have no clue about. It truly just becomes a gamble and a guess, and that's what the majority of people do. And guess what? That's why NFP is notoriously known for crashing people's accounts, right? So I don't like to play it that way. What I like to do is still understand the overall market structure of whatever we're going to trade. Because if you're trading NFP, you don't essentially have to trade gold. You could go trade some US dollar pairs or the US equities as well. But me personally, I like to trade gold in the US dollar pairs because usually the impact is pretty standard. What I mean by that is, I don't know if you guys saw the poll I asked to chat, but what I mean by the impact being very standard is like, if the economic data is extremely good and very optimistic, showing economic recovery, it's a bearish impact on gold and a bullish impact on the dollar. But there's something different in play over the last week that's going to further influence, supplement, and complement this. For those of you who don't know, this aggressive downside move here on gold, as well as this aggressive downside move here, this one came from Joe Biden selecting Jerome Powell to be the Federal Reserve head again. For those of you who don't know, Federal Reserve and their policy positioning regarding the monetary policy has the largest impact possible on gold, US dollar, and of course the stock market, right? It's literally the central bank that prints out the US dollar, dictates the supply, dictates the flow of the US dollar within the global economy. You know what I mean? So anything the central bank does or potentially signals at has major impact on the potential markets that we trade, such as gold, US dollar, equities, and so forth, right? And what we have been seeing over the last week is that this was when Joe Biden selected Jerome Powell to be the Federal Reserve head again. And this downside move here on gold that led to lower lows here and still respecting overall bearish market structure with sellers consistently printing lower lows. This was from Jerome Powell signaling that inflation has finally become a risk, is no longer transitory, and that the economy is now strong enough, with inflation being too high as well, where they need to start combating that inflation. For those of you who don't know, the reason that US inflation was so high is because when the pandemic first hit the scene, and don't worry, remember we got an hour, so let me rant, let me give you guys the information. When the pandemic first hit the scene, right? You can see that within, this is a 20-year range of the US money supply within circulation of the economy, right? So you can see for 20 years, we had this general pretty healthy inclination here. A little bit of a spike when they increased the money supply during the 2008 crisis, but 40% of all US dollars were printed with an exponential increase during the pandemic crisis. Okay? The central bank, Federal Reserve, working hand in hand with the US government to support the economy and prevent it from crashing, to give people their stimulus checks, to pump up the markets through their asset purchase program. They turn on their magic printer, they turn on their magic switch, they literally increase the money supply out of thin air, right? And you can see this huge exponential increase in US money supply. This is the major contributing factor to the increase in economic inflation within the US. Because what happens is, when you increase the money supply of the US dollar within circulation of the economy, it decreases the value of the dollar and increases overall inflation, because supply and demand impacts anything. If you have high supply of a good, service, commodity, or currency and a low demand, the price of that product or whatever it may be drops, right? It's the same thing for the US dollar. So you can see when they increased the US money supply at the start of 2020, you can see when you come look at the US dollar individually here, right? You can see that at the start of the pandemic, when they increased the US money supply exponentially, the actual dollar value went from 103 and had this bearish impulsive move all the way down to 89. So what happens is the Feds increase the money supply, and what they are trying to do is prop up the markets. They take this money supply and they start buying up commodities, like to make sure the economy doesn't crash. Everything that's a part of the commodities list is a part of their asset purchase program. They start buying up stock market ETFs and pumping the market. They started handing out checks to people who lost their jobs and providing that stimulus. So the payoff in the cost of this printing is not essentially paid by the rich or by the 1%ers or by the government. It's the people and us who pay the price. How do we pay the price? Well, over the last year and a half, every single dollar in the pocket of the Americans has gone down in value exponentially, right? So you've seen that the buying power of their dollar has gone down, but the cost of goods and their cost of living has gone up because of inflation. So you have this double whammy that the collective millions and millions of citizens pay together, with having less buying power on their dollar and having higher inflation and higher cost of goods, right? But the ultra rich and the central bankers and the ultra wealthy, they don't give a shit about this, because who do you think are the rich who got richer when all that money supply is also going in to pump up the stock markets? You can see that the stock market from the pandemic crash has gone from a point of 18,000, 19,000 when the circuit breaker was hit and no more short selling was allowed, almost doubling in value over the last year and a half, 2 years. The same time that the pandemic has still been active, we're also almost 6,000 points above pre-pandemic price points as well, right? So this upside rally on the stock market makes the rich even richer, makes the corporations even richer, makes the parties involved even richer. who do you think the primary parties involved in the stock market rally are? Do you think it's your grandma? You think it's your hardworking uncle? You think it's your hardworking cousins in the factories and in the offices? You think it's the majority of the masses making the money off this? No, it's not, right? It's the rich getting richer, and this cycle constantly repeats every 10 to 15 years, all right? So, what I want you to understand is that during this time period, when the US dollar was extremely bearish, right? The Federal Reserve was keeping interest rates low and keeping stimulus active, right? Up until the last few months of FOMCs, where they have started to give tapering confirms as well as potential future rate hike confirms. Okay? So when you have to understand, when they increased the money supply, when they were going full force with their asset purchase program, when interest rates were staying low, these were all bearish factors for the dollar and bullish factors for gold, because higher inflation is bullish for gold, because investors hedge inflation risks by pooling into gold. And also because lower interest rates is also a bullish factor for gold. This is why you can see gold did the same thing that it did during the 2008 financial crash, right? It's because of, even though the catalyst is different, and this time it was a pandemic, and last time it was a financial crash with mortgage-backed securities collapsing, the steps the central bank took was the same. And that's what really impacts the market, and that's what I'm trying to convey to you here. So what I'm trying to get across here is that we can see that now dollar is entering more of this bullish rally as we've had tapering confirms, start of tapering confirms, and potential future rate hike confirms. We can see that dollar also bursted to the upside here, and that was primarily when Jerome Powell this week with Janet Yellen came into the scene and said that they are going to have to be more aggressive with tapering and potentially look at rate hikes in the near future, because inflation is no longer transitory, inflation is a risk. So when the central bank gives signals that they're going to be more aggressive with tapering, and that they're also going to be looking at rate hikes in the near future for 2022 to start fighting the high inflation, to start combating the inflation, and also because economic data is recovering, which I'm going to get to in a second. Investors price this in ahead of time, buy the rumor, sell the news, and dollar has been going up just at the rumors of potential tapering starting, then getting signals of when the tapering could start, then the actual tapering starting, now potential more aggressive tapering coming, and rate hikes in the near future. Okay? So we can see that this week, Jerome Powell said inflation is now a risk, right? I'll search it in the newsroom right here for you guys. Look, Fed Powell, November 30th, said it's time to retire that the term transitory for inflation. Okay? So you can see the risk of Fed Powell, the risk of higher inflation has increased, right? So when he's saying that the risk of higher inflation has increased, and they're also giving signals to start do more aggressive tapering and potentially increase increase interest rates and obviously hike the rates, this led to a bearish impact on gold, because what the Fed is signaling at is they're going to start to fight the inflation. That's a bearish impact on gold. That they're going to start doing aggressive tapering. That's a bearish impact on gold. And that they're going to start to raise interest rates. That's a bearish impact on gold. We can see that the Fed's sentiment and what Jerome Powell said is still holding weight. And for the Federal Reserve to say that they're starting to get ready to raise interest rates and do more aggressive tapering also means that they see that US economic data is a lot stronger. You have to understand that besides all of the fear and all of the uncertainty that has been going on in the mainstream media and news, the US has not been in a lockdown. There has been nothing to actually impact economic activity in the US ever since they came out of a lockdown. They can keep talking about COVID all they want. They can keep talking about vaccinations all they want. But unless the US goes back into lockdown, what is impacting economic activity? right? So now, we can see now when we're looking at our labor market data today. This guy's a fucking retard, man. So many retards. So now, what I'm getting to is we can see with the labor market today, right? That the expectations is still non-farm payroll is going to be good. Private payroll is going to be good, and unemployment rate is going to see a drop. The same time that Jerome Powell just said this week that the economy is very strong and inflation is at a risk and they need to start combating the inflation. We also saw from the previous week that the JOLTS job opening data was still good. The jobless claims was still dropping just yesterday, and the ADP private sector data was still good. I also want to show you guys something that is different from what the mainstream media is telling you, right? The mainstream media is bringing you all this fear, uncertainty, and doubt regarding the US economic condition, right? But I just want to show you guys the actual raw data. This is the maximum chart in terms of a 20-year range of economic data for non-farm payrolls within the US. What I'm about to draw out, you can see this is what's considered a healthy economic range, right? When non-farm payroll is within these ranges and these highs and lows, that's what's normal, right? You can see we had this massive decrease in non-farm payrolls, obviously when the pandemic first hit the scene. And you can see when the US came out of lockdowns, we had this surge in jobs. That was also abnormal. What is highlighted in red and what is highlighted in green are both abnormal figures. This was due to mass uncertainty, doubt, and fear in the US being in lockdown and economies actually being stagnant. And this was due to a surge in non-farm payrolls when you came out of lockdowns, right? But you can see ever since the last period of maybe 4 to 5 months, non-farm payroll data has been back to normal economic conditions in an overall macro range. Does that make sense to everybody? Unless the US goes back into lockdown, there's nothing really impacting the labor market. It's not like people are back to work in the US. What you tell me a reason what would impact the labor market if you don't have lockdowns that can bring you back down to these types of negative figures. Do you understand what I'm saying? So non-farm payrolls overall trend, you can see even in the 5-year, this is normal economic range for non-farm payroll. This was a spike down, obviously pandemic lockdown. This was the surge in job creation when the US came out of lockdown. The range we have been in since the start of 2020 has been normal conditions for non-farm payroll compared to the last 10 to 20 years worth of data. Okay? Now that's the non-farm payroll. We can also see that just looking at the overall yearly trend, non-farm payroll is just having these healthy figures. And we can also see that ever since December, we've been seeing an overall increase. 200K was the low here in April. 200K was the last lows in the August and September. And from there, we did see a good surge. We also didn't see any further lockdowns within the US. Be aware that Europe is going back into lockdown. This is United States non-farm payroll, you fucking gulaggers. Oh my goodness. Sometimes I wish I didn't speak so much. But anyways, so we can see non-farm payrolls for the United States, the American flag here, right, is back into normal economic conditions, right? And what the expectation with the 20-year max and the maximum figures is that we are back to normal conditions here in non-farm payroll. That's not all. That's not all I want to show you. Let's come here and look at the US unemployment rate. This is the US unemployment rate. This is the maximum chart for the US unemployment rate. 20 years worth of data. United States, American flag, United States specific unemployment rate, 1984 to 2021. All right? You can see that this surge in unemployment here was the 2008 financial crash. This surge in unemployment here was the 2020 pandemic crash. Okay? The labor market impact was much larger from the pandemic because obviously it led to the entire economy being stagnant and locked down, where the 2008 financial crash primarily impacted the financial sector within the US and had a ripple effect after that to any correlated job sectors that are heavily tied to the financial sector. But the labor market impact from the pandemic was obviously much larger than 2008 because it actually led to a full lockdown of pretty much the entire economy for that extended period of months, right? Holy fuck, man. These guys are retards. Hide this retard too. Get this retard out of here. This is a US labor market stream. We don't care about... Oh my god. Where do you guys... How does Roger deal with the gulaggers? They got short attention spans and low IQ, man. Anyways, this right here was normal conditions for unemployment. This right here was normal conditions for unemployment. Right here where we are is normal conditions for unemployment within the US. Okay? So the US unemployment rate over the last period of months and year has been right back to normal conditions. Remember, this was abnormal during the 2008 financial crash. This was abnormal during the pandemic. But within the mainstream media, they can keep talking about the vaccines all they want. They can keep trying to scare people with COVID fear. Unless the US goes back into lockdown, you tell me what would be impacting the economic activity. Yes, there are some supply chain issues evident, but that's not really essentially impacting the broad labor market within the US, right? Ever since the US has been out of lockdown, yes, there's still been fear regarding COVID. Yes, they've been trying to push vaccines, but people have gone back to work and the numbers clearly show that. And you can also see that people have gone back to work at the rate which is normal for pre-pandemic figures, both on non-farm payroll and both on unemployment rate, okay? So, in my opinion, I personally think the unemployment rate is still going to be good. I still think non-farm payroll is going to be relatively solid because this new Omicron variant, it hasn't led to people quitting their jobs, and it hasn't led to a vaccine mandate, and it hasn't led to a lockdown yet. Do you understand? So they can push all this fear with this new Omicron variant, but how is it impact? You have to ask yourself, how is it impacting the labor market yet? How is it impacting economic data like retail sales yet? Actually, retail sales and spending is increasing right now because we're still entering the holiday season and people are trying to find any little bit of joy possible during this whole 2 years of depression, where this Christmas is going to be huge for people if there is a Christmas and there's no lockdowns. So you know what I mean? Right? What we can also see is, besides the non-farm payroll, besides the unemployment rate, right? We also had the initial jobless claims report. And just this fresh months of initial jobless claims report, here's the 20-year max on initial jobless claims. Same thing, right? You can see that this is right here is normal economic conditions in range for initial jobless claims. Jobless claims obviously being unemployment claims filed by citizens who lose their jobs for whatever XYZ reason. This little blip in jobless claims here above the normal range was the 2008 financial crash. This monstrous spike in jobless claims was obviously with the pandemic. But you can see ever since 2020, and we're going to narrow down on another chart as well, jobless claims has been on a steady decline and is well into pre-pandemic figures and is well into healthier economic ranges. And even when you come look at it on the yearly chart, this has been the trend of jobless claims. On the 2-year chart, you can see the spike and then decline. On the 1-year chart, you can see the healthy decline. Yes, you get some off reports that show you a spike in jobless claims. But regardless what the media is telling you, jobless claims has been on a steady decline and is back to pre-pandemic levels. And we saw that jobless claims yesterday was good as well. You know what I mean? So what can we deduct from this? Well, what we can deduct is that this week, Jerome Powell himself said economic data is stronger. The economy is looking a lot better. We just need to get more people vaccinated, right? We also had Jerome Powell say they need to start doing more aggressive tapering and also look at future rate hikes to start combating this inflation, which is now a risk. Just Jerome Powell talking about more tapering and future rate hikes had a bullish impacting factor on gold. Had a bullish impacting factor on dollar and a bearish impacting factor on gold, right? Ferb, you just said economy does not really relate to the market. The market's controlled by algos. Jerome Powell came at exactly 10 a.m. Eastern and said he's going to look to hike rates and inflation is not a risk, and we melted. Why is that? It's because the algos that the institutions are using in programming still get adapted and tweaked to follow the central banks and main market movers. You fucking idiot. Right? So you can see here, this fundamental catalyst why gold's dropped was literally a headline of Joe Biden selecting Jerome Powell to be the head again. Here, this drop on gold from 1803 to 1772, was Jerome Powell saying we're going to start to increase interest rates and taper, and inflation is a risk we have to fix now. Right? And today, if NFP is really good and the jobs data is good, we might get a liquidity grab, but gold still on that stronger economic data continue its way down. Okay? So this is what I want to get into and what I want to summarize to everybody. Okay? So, let's recap, shall we? I like to read the comments because it's funny. I'm not actually annoyed or irritated. I enjoy doing this stuff. So don't take my roast so seriously. You know what I mean? I'm not actually trying to make fun of anybody. It's just, it makes them more entertaining. You know what I mean? But anyways, let's get back to the topic of conversation. We had signals this week from Jerome Powell and other Federal Reserve speakers that they're starting to get to the point where it's looking smart to start rising interest rates in the near future. Also saying that they need to start aggressive tapering more, okay? The reason, you have to understand that for the Federal Reserve, the body and party that dictates the supply and value of the US dollar and has some of the largest impact on the US economy, right? For them to say that it's time to start raising interest rates and also to start aggressively tapering means that there are certain metrics that have been met on where the economy is currently sitting, okay? Please let me say that again. Please let me say this again. For the Federal Reserve, okay, for those who don't understand, if the Federal Reserve increases interest rates, it can have a major impact on the economy if the economy is not strong enough to handle those rate hikes, okay? Because when rates get hiked, the Federal Reserve is essentially trying to get money back that they previously put into the economy to support the economy, right? And when they hike rates, this raises rates for everything down the line. Mortgage rates, loan rates, credit card rates, and so forth. So if the economic condition of the US isn't strong enough to handle the rate hikes, it can be very dangerous to prematurely hike rates. for the Federal Reserve to say that they are starting to potentially look at rate hikes and also look at more aggressive tapering means they are seeing the same thing I'm showing you, that economic data has heavily rebounded and is coming back to pre-pandemic levels, right? So we had signals this week of the Federal Reserve saying they're going to start to look for future rate hikes, as well as also look to be more aggressive tapering. This is what led to the impulsive drop on gold and the impulsive upside move on the dollar, right? We can also see the potential that what I'm showing you guys, non-farm payrolls is back to pre-pandemic levels and healthy numbers. Unemployment rate is back to pre-pandemic levels and healthy numbers. Average earnings is back to pre-pandemic levels and healthy numbers, right? We can also see that jobless claims is back to pre-pandemic levels and healthy numbers. My expectation, my bias is that this data is going to be neutral to good. I don't think it's going to be extravagant data, record-breaking data. But I do think it's going to be neutral to solid economic data that's going to further support what Jerome Powell said earlier in the week about potential tapering and rate hikes to come. But I do see that for something like gold, we can get potential liquidity grabs before continuing our way down with the safer sells below 1764. Okay? So now, with everything that I said, you can see that gold is still respecting this bearish market structure. We still have sellers impulsively printing lows, only having pullbacks to collect more sell orders from an institutional perspective, and continuing us to drive down into the lows. Okay? So my expectations is that the data is going to be good, and we can still get a potential liquidity grab to 1781. So now I'm going to lay out my biases here, as we have about 24 minutes till the data release. If the Fed start to increase rate hikes, it's gonna put the stock market into a bearish corrective trend for a period of weeks and months. And for you to reference that, go look at what happened on the US 30 stock market index during the 2008 financial crash. You can see when interest rates were very low and stimulus was active, the stock market pumped extremely bullish, right? But then when the Feds look to increase interest rates, I'll just show you right here actually, right? This was, and it's not going to be a huge crash, it's going to be a correction. Okay? This is the 2008 financial crash impact on the stock market. This was the rally that took place years after, as they were pumping the markets and also had lower interest rates and stimulus active. When they rose interest rates, when they started tapering, this was the correction. When they rose interest rates, this was the correction. It doesn't break the overall structure, but it does create a potential bearish correction, as higher interest rates is a bearish factor for stock market buyers. Stock market buyers love low interest rates. They love to ride the wave of the Feds pumping the markets. Okay? And remember, I'm not a genie. I'm not a fortune teller. This is just my deduction based on the information the central bank gave us, based on the current price action and market structure, as well as based on analyzing the economic data. Okay? Now, obviously, I'm not the institutions, I'm not the set all be all, and everything I say might not play out. But that's why now we're going to map out the possible other opportunity of where I would see safer buys, okay? So these red box areas are going to be the sell zones. If we get a pullback to the bearish market structure, in the key level in this last lower high price point, and also going to be potential sells below 1764. There is something called stupid questions 100%. Okay, listen. Some of you guys are taking the roast or saying stupid, dumbass, and all this shit too seriously, and you guys have really thin skin to be a trader. If you were in any type of trading floor 20 years ago, all you would hear is screaming, people swearing at each other, then they make their money and go fuck strippers after and go have drinks together after. All right? You guys gotta calm down with your baby fucking soft, sensitive emotions, and you're trying to trade non-farm payroll. Happy birthday to Macedonian. Everybody happy birthday to Mac. Nobody cares about his birthday because it's NFP. Mac's turning how old? We don't give a fuck. It's NFP. I'm kidding. Happy birthday to Mac. Happy birthday to Mac. Happy birthday to Mac. Okay? Now, I'm only switching out of this bias and taking gold buys if we break above the bearish market structure and my bias is wrong and we have very bad economic data. All right? This is just my 2 cents. You guys can do, it's not my birthday, man. It's Mac's birthday. Kind of saying happy birthday to me. Okay? So this is my main bias based on the factors that I told you guys of first, the Federal Reserve telling us that they're getting ready to start rising interest rates and do more aggressive tapering because inflation is now a risk. Jerome Powell and other Federal Reserve speakers also discussing how economic data is a lot stronger and the economy is way more robust than it was during the pandemic. Number 2, ADP private sector data was still solid prior in the week. Number 3, jobless claims was still showing us a steady decline in improvements as well. Number 4, when we looked at the data of non-farm payroll, unemployment rate, wages, and jobless claims, we can see that the data is well below pre-pandemic levels and is in ranges that we would call healthy economic conditions. Number 4, we have bullish overall structure on the US dollar, where good economic data, potential of aggressive tapering and rate hikes is all bullish factors for the dollar, and we currently have bearish structure that's still being respected on gold, with sellers continuously driving price down to lower lows, and we've only had pullback phases that collect more sell orders before driving price down again. I can see the potential for a liquidity grab, as it's very possible, and we've seen that many times before, or just the continuations right back below 1764 and 1759, okay? My main bias, based on the information I am giving you guys, is looking for gold sells and playing US dollar buys. But am I always right? No, I could be 1000% wrong. It could come out that this labor market data is completely terrible. If I am 1000% wrong and the labor market data is completely terrible, the only way I am shifting out of my seller bias on gold is with these confirms listed here. The US dollar will have to be weak and turn bearish. The jobs data will have to be terrible. We'll have to break above the bearish structure and break above 1789 for me to take buys. Does that make sense for everybody? Does everybody understand my main bias and what we are potentially going to be adapting to? Yeah, I might even put a low risk sell limit at 1781 if we have a liquidity grab. But let's see the data in 15 more minutes. Sakim got kicked out of CH. All right, so so what time is it right now? 8:15 a.m. Eastern. So keep that in mind, screenshot that, you know what I mean? I'm about to delete it off the screen for now. And the anticipation is, when I'm looking at the US dollar here as well, the dollar might do a bit of a liquidity grab, but it's far too bullish, right? The only thing we've had happen on the dollar is have these highs printed in pullback phases, with price being driven down to a more favorable demand zone and continuations back to the upside, right? This is why GU, AUD, USD, Euro USD has been so bearish, because of obviously the stronger economic data we've seen and investors starting to price in the interest rate hikes to come in the near future and tapering confirmed by the Feds. Even if NFP gives us a spike down but doesn't break below this demand zone in previous high area here, I still have the expectations it's going to be driving up back up to these 97 highs. Okay? So my bias is still holding the bearish bias on like GU, the bearish bias on Euro USD, and the bearish and the bullish bias on USD CAD. But obviously, with the volatility that comes with the labor market report, you can get very aggressive liquidity grabs in whipsaws. Okay? The only other thing that we have to be cautious about is what we want. Let's just say my prediction is wrong, right? Let's just say the data is extremely bad and gold pushes up and dollar pushes down. That's perfectly fine. But what we want is consistent data across all these reports. We don't want mixed reports that's just going to cause a whipsaw and some quick impulsive moves and start ranging, because then it's pretty much one of those NFPs that's a dud and it's not really any useful, right? So what I want is either all of this data across the board to be very optimistic and strong and just lead to a gold drop, or all the data to be very poor. You guys all know my bias anyways. And something else you have to look out for that's going to be very neglected today, because the focus is always on the labor market data, is we have just as important US economic data an hour after and at the 10 a.m. Eastern candle from 9:45 to 10 a.m. PMI figures are very important. Factory orders is very important. ISM non-manufacturing PMI, services sector PMI, and composite PMI, right? So there's some various scenarios that can happen. For example, we could get very good data for all of our labor market figures and take advantage of the gold sells. But you don't want to get greedy and try to continue to hold on a Friday, because if this PMI data is bad, it's just going to lead to a whipsaw move an hour after during post NYSE open and going to fade out the impact from the labor market data and create a lot of indecision. The strongest movement possible today would be if the labor market data is very good and the PMI data is very good, and gold should essentially have a strong meltdown to close off the week, and dollar should push very strong bullish, as all of that stronger economic data already has that impact. But it also further supports the sentiment and statement given by Jerome Powell this week that, hey, we need to start rising interest rates. We need to start combating inflation, right? We need to start looking to do and start doing more aggressive tapering, because the economy is strong enough to do it now. And the data is supporting that, right? You know what I mean? But at the end of the day, remember, I'm not a fortune teller. I'm not the set all be all. There's been many times before where I've been wrong. So that's why we like to create, and that's why I'm not just mapping out the one bias. I'm also telling you guys other possible scenarios, because psychologically, when you map out these, when you have a main bias, that's perfectly fine. But when you also psychologically map out and understand the other various scenarios, when the time comes, you can adapt more efficiently and adapt to switching out of your bias more efficiently, right? For example, my main bias is this: good data, dollar strength, gold either reject 1781 and drop, or just break below 1764 and drop, right? But let's just say the data comes out and the data is very bad and gold breaks above 1789. Well, I already have this scenario set up where I can digest that this data is very bad. That's number one. Then confirm the price action that gold is pushing up. That's number two. Then confirm I'm breaking above the buy zone I'm looking at. That's number three. Does that make sense to everybody? Because at the end of the day, I'm a manual retail trader just like all of you. I don't have access to institutional order flow. I don't have access to insider secrets. You know what I mean? All these people who come to the chats and say, oh, gold's gonna hit this MA, gold's gonna do this algorithmic trade, they're just talking out of their ass. They don't actually have any experience, skill set, resources, or knowledge to know any of that. You know what I mean? It's just them being personally attached to a bias. I don't like to be personally attached to any bias in the market. I like to have what I'm possibly seeing as a main bias, but also have the other scenarios to adapt accordingly. You know what I mean? Also, remember, with the volatility that can come from the non-farm payroll data and the labor market data, even if you are right, let's just say you trust me and you take a high risk sell before the news, right? Even if you are right and gold starts to drop, you can still lose, because if the volatility and volume is strong enough, there's some. Have you guys ever seen NFPs where it does a 30 pip spread spike before the news release, or it does a quick 30 pip upward spike and then drops, or does a quick liquidity grab and drops? You know what I mean? How many times have you guys seen that? Where let's just say the NFP data is very good and gold should drop, but it spikes up first 100 pips, then melts. Or it instantly drops, but it does like a 40 pip spread spike first, right at the release, then drops. You know what I mean? Stuff like that due to the high volatility, and if you have an inconsistent broker, it'll slip your entry, it'll slip your stop loss. It'll spike and take out your stop loss with those spread spikes and so forth, right? So that's why you have to be very cautious. Don't fall for the hype of being a hyena and thinking you're gonna 10x your account because it's NFP volatility. You still have to follow your risk management plan, follow your trading plan, and focus on your long-term vision and keep emotions out and avoid crashing your account. Okay? You know what I mean? So don't be a freaking idiot. Our primary focus as a trader is not to profit. Number one rule is first protect capital and survive. Why do you think 99% of people lose? They don't even know how to survive in the market, but they're trying to profit all the time. How can you learn to profit if you don't even know how to freaking survive? Imagine the market is a huge ocean. The market is, as for investors, seen as a huge ocean. That's why you have this different terminology such as liquidity, such as market whales, and so forth. Imagine the market is a huge ocean and you have to jump into the ocean, potentially catch a fish and hunt the fish to eat, but you don't even know how to swim. How are you gonna go jump in the big, deep blue ocean that has all this mystery, all this uncertainty, all this danger and risk, and you're gonna try to catch a fish, but you don't even know how to swim? So think about it in the market that way. Number one rule first in the market is first learn how to survive and float. Then go try and hunt. First build a boat. First learn how to swim. Then go try and hunt for some fish. Do you understand what I'm saying? And even worse is what Playful Highlights just said. You'll have idiots who don't know how to swim, and they won't even go in the ocean and try to catch a fish. They want to catch a whale. They want to freaking be Moby Dick. You know what I mean? They don't even know how to swim, and they have expectations that they're gonna go catch a whale. 100%. I like that one. They think they're freaking Moby Dick out here. Oh man. Also, for anybody who trades, for example, GBPJPY, and you notice that during non-farm payroll, GJ has an impulsive move as well, that's because the economic data, even though it's US economic data, it's going to have an impact on the Japanese yen as a safe haven currency. Okay? The Japanese yen is primarily treated by investors as a safe haven currency. So when you have very strong market optimism, for example, very strong economic data, the Japanese yen weakens, GJ will spike up a bit. When you have very bad economic data and it's seen as market fear, the Japanese yen picks up some strength, GJ drops a bit. That's why if you guys have ever noticed non-farm payroll releases, it has this like side effect impact on GBPJPY. It's not as big of an impact as you see like on gold or the dollar, but you still see GJ move on the news release, right? Have you guys noticed that before? It's not because the data is impacting GBP, it's because of the impact on the Japanese yen as a safe haven currency. That's a good point by Razy Laz as well. Most people are trying to like take $100 accounts and envision going to 100,000 in a few months or tripling their account every single day. Like these types of percentage gains are not going to be consistent to hold out on. You know what I mean? And if we do break below 1764 and the data is really good, I would expect at least printing some lower lows, as we've seen these various ranges before lows be at least like 100 plus pips. So at least like maybe come and at least print a new impulsive low to 1750s. Only switching out of this bias if we come above 1789. But my main bias is the sells potentially. This is my main bias. Main bias. I'm only switching bias if this, because obviously I can be 100% wrong. You know what I mean? Let's get our bad boy up here. Got about 3 minutes left. And now we sit and wait. And for anybody who wants to do sell stop, buy stop, that's up to you. I'm not advising where to put it. Don't message me after, oh, my sell stop got activated and took me out. Then my buy stop got activated and took me out. I don't want to hear it. You know what I mean? If you guys want to do sell stop, buy stop, you guys go for that. If I'm going to take something, it's going to be way smaller than the normal lots I usually take, for sure. I'll probably only use like a 2 to 5 lot if I take something. But yeah, we'll just wait for the data. We'll see what happens. Remember, everybody, it's a Friday. You don't want to ruin your Friday by crashing your account. You don't want to destroy your week's worth of profits by crashing your account. Yeah, about 45 seconds left. Looks like it's going to do a liquidity grab first or something, but we'll see. Freaking alert's a bad time for the alert. So we got a little whipsaw liquidity grab. Oh, very bad data. Very bad. Actually, unemployment rate's really good. Non-farm payrolls is bad. It's mixed data. NFP is very bad. Unemployment rate's really good. Unemployment rate dropped by 0.3%. So this one's good. This one's bad. This is going to be a shitty NFP. Now we're going to have to see how investors digest this data. Unemployment rate's really good. Dropped by 0.3% from the forecast. Dropped by 0.4% from prior. But the non-farm payrolls is very bad. So it's just going to cause a whipsaw. Yeah, we have mixed news right now. Mixed data, not much of an initial impact. It spiked up about 30, 40 pips. No one-sided economic data here. This looks like this is going to be a shitty NFP in my opinion. You have mixed data, what we did not want to see. Very good unemployment rate decrease, very bad non-farm payroll. So we're just going to be whipping. It's going to do a double-ended dildo candle. Scratch everything. This is a dud NFP. Oh man, I wanted my NFP stream to be a freaking fireworks. Oh. You know what I mean? I didn't want a double-ended dildo for my NFP stream. I wanted really, okay, even if my bias was wrong, everybody, even if my bias was wrong, I at least wanted all the data to be bad. You know what I mean? Bro, euro, yeah, dollar pairs, whipsaw. GU just did a whipsaw move. Gold just did a whipsaw. Freaking double-ended dildo. This is not what we wanted, everybody. I'm so sorry. Obviously, it's not my... Wait, why did I say sorry? Obviously, it's not my fault, but... we got mixed data. We got mixed data. So the market's just whipsawing, and we're trying to see what investors are digesting more. You know what I mean? We got mixed data, everybody. What do you want me to say? These are the main two, non-farm payroll and unemployment rate. But unemployment rate was really good. This doesn't even make sense how unemployment rate can be so good, but non-farm payrolls can be so bad. Double-ended dildo. It's a double-ended. You guys haven't seen these double-ended dildo candles before during news? It just fucks It just fucks anybody who's trying to jump in. Alright, everybody. I don't really want to fight the market here on a Friday. Hopefully everything was still educational and useful for you. But sadly, this Friday is so far a dud. But same trade ideas still stand. Okay? If gold comes to 1781, rejects, and breaks below 1764, I'm still looking for sells there. Okay? I'm still bearish bias gold, bullish bias dollar. Same trade ideas still stand, but this was just more of a dud in terms of the actual impact, all right? But if you guys re-watch this stream and take notes, the same trade idea still stands. Same analysis still stands. Also, we have the PMI data later. I think that gold will see the drop later with the stronger PMI data. Right? And dollar didn't really drop. Dollar did exactly what I said with a liquidity grab. You have to look at, like, dollar did bigger movements yesterday for fun. Then dollar did bigger drops yesterday just dropping for fun, ranging, than it did on NFP today. Right? This isn't really much right now. I still see dollar bullish. I still see gold bearish, all right? But right now, sadly, for my NFP stream, we had mixed data, very good unemployment data, very bad non-farm payrolls, creating this indecision on the dollar and gold, creating this double-ended dildo candle. Okay? If more people are checking out of the workforce, unemployment percent would be higher. So that's not how it works. The fact that unemployment rate is dropping means that there's less unemployed people. There's more people within the workforce. That's the same thing we saw with jobless claims as well. You know what I mean? Euro USD, whipsaw move. GBP USD, whipsaw move. GJ just held the same buy zone. Gold, whipsaw move. If you guys want me to do another stream next week, more educational content, let's get to 500 likes. But how many people are watching right now? How many likes do we have? I can't see the YouTube, that screen. Mr. Mobe, guys, please don't try to teach me about economic data. All right? Please don't try to teach me about the economic data. I think I know how unemployment rate is calculated. It is simply from the Bureau of Labor Statistics, of market labor statistics, of how many unemployed people there are through the seasonal changes and month over month and quarterly changes. Okay? If you guys want me to do these streams more often, let's get the likes up. I don't know how many people are watching right now, but just so these streams get more exposure. Today's NFP was a dud. But anyways, everybody, even though the non-farm payroll today was a dud, we had mixed economic information and data, just creating this ranging and double-ended dildo candle. Make sure you re-watch this, because there was tons of information given through this webinar. All right? Make sure you re-watch this. There was tons of information given. Also, make sure you check out all the Capital Hungry resources. Free Telegram analysis channel, the Capital Hungry YouTube page where you have all this educational content at your fingertips, the Capital Hungry News Twitter, which posts more headlines. Capital Hungry News Twitter just hit 27,000 tweets. The Capital Hungry News Twitter has posted 27,000 headlines since being opened. 27,000 headlines. All right, so Capital Hungry News Twitter, the Capital Hungry YouTube page itself with over 100 plus free webinars, on trading, psychology, educational webinars, and so forth. The Capital Hungry Telegram analysis channel. There you can go see like news headlines I share, analysis, you know what I mean? Trades I take, webinars I do, withdraws. You can go look at my Capital Hungry business license. You can go look at all the trades I've taken over the last month here. You can go look at the last withdraw. You can go look at the last profits and stuff I shared. You can go look at the last withdraw I did from Dominion Markets. Best broker in the world, Dominion Markets. Raja Banks. No, Dominion Markets is actually good for Canadian clients as we don't have many options. You know what I mean? You can go check my withdrawals. You can go check my trades. You can go check my business license. And you can go check all the information. Thank you everybody for attending. Thank you for the support. I appreciate it. Sucks that today we got a double-ended dildo. You know what I mean? We didn't get what we wanted. But hey, it is what it is. We're not here to fight the markets. Everybody have a great Friday. Have a great weekend. I'll see you guys next week for some fresh content. All right? Have a great weekend, everybody. Everybody lower your volume right now. Dominion ad coming in 3, 2...